It's Brian Preston, the money guy.
Let's transition now to the second component, dividend yield.
Okay.
This one's interesting, Bo, because we've seen some historical changes on this. By the way, let me give you some perspective. If you want to know what is the dividend yield of the S&P 500 right now.
What is a dividend?
A dividend is a company, realize that a company that has profit, they can either keep that profit inside the company to grow the business, or they can say, you know what, we want to reward our shareholders, the people that invested in our company. We're going to issue a dividend or a distribution that will go out to all the people who made an investment into our company. So that's what a dividend is.
Perfect.
It's basically a payout to your shareholders to give them, I don't want to say thank you because it's not necessarily thank you. There are expectations that you're going to share the return that you make of the profit. But the dividend yield on the S&P 500 right now, or at the end of 2017, we'll say, because we're a few months past, the close of 2017, is 1.85%. So a little under 2%.
Is that high, low, where it's supposed to be?
I'm going to give you a number. I'm going to answer your question, but I need to give you some history after that. The historical average is 4.41%.
And you said we're at 1.85 as of the close of last year.
So you're like, wait a minute. That's half of the historical average. So I need to tell you the rest of the story. Let me go ahead and give some more historical stats just to give you even more perspective. Is that the all-time low on dividend yield for the S&P 500 is 1.11% in August of 2000.
Okay.
So that's, after we kind of hit the dot-com bubble.
Sure.
You can imagine when technology stocks were driving the stock market, you probably didn't have a lot of dividend-paying companies in the S&P 500, so that's why the yield was 1.1% at that time. The record high for dividend yields was in 1932. We had to go back a ways, and it was 13.8%.
Wow.
So here's the rest of the story, because I feel like you need some perspective on this, is that because interest rates are so low right now, historically, now they are inching up.
Sure.
But they are historically low right now. That's put where it's attractive to have low dividends because interest rates have been so low. There's no competition there. But then there's also, since really the 70s, people, investors, professional investors, institutional investors have realized, that there's a lot of tax negatives to dividends. Let me explain what I mean by this. Dividends are not tax efficient because not only does the company pay income taxes and then they get to issue the dividend. So the dividend is actually after the company has paid income tax on the money. But then when the investor or the shareholder receives their dividend, they also pay income tax on it.
So it's a dividend by the time it gets to your pocketbook, by the time you actually go spend it, it's been taxed 2 times. It's a double taxation.
So companies have realized, oh man, so this is not the most efficient thing out there. So what you've seen a shift in is that you see companies now buying back their shares instead of issuing dividends.
So if I'm a company and I have a bunch of excess cash sitting in the bank, I can either distribute that to all of my shareholders and send that out, or I can go out in the open market and start buying my own company stock. Why would I, as a company, want to start buying back my own company stock?
Also, but here's the thing. I always like to challenge people to think in a macro sense, too. I told you this all started changing in the 70s and really into the early part of the 80s. What happened in the 80s is we had the personal computer come about. And then after the 80s, you start thinking about the internet boomed in the 90s. And then from the internet boom of the 90s, you transition to the mobile society of, you get into iPhones, iPods, and all the other mobile devices. Every one of those trends I told you in the 80s, the 90s, and the 2000s are all technology-based. Mm-hmm. So if you're a company and you're a technology company that is growing your earnings through straight-up innovation, that extra dollar is probably more valuable to the company because they can either go buy greater technology, they can spend it on research and development, versus sending it out there to the shareholder. It's the same thing. It's kind of what you and I have been talking about, Bo. Where is the dollar going to be most efficient and best used? Sure. And since we've had this tilt towards investing towards technology and innovation, that's another reason you've seen a push towards dividends not being paid out, because dividends also show you where the company is in its life cycle. I'll give you a perfect example. Apple didn't issue dividends forever.
Okay.
All of a sudden, they started having all this cash build up because Apple had a lot of big hits with the iPod, transitioned into the iPhones, cash building up. All of a sudden, you get these advocate investors who start saying, Apple is carrying so much cash
and you start
that they need to start giving some of it back in goodwill to their shareholders. So they kind of fell to the peer pressure and they have now started paying. So that showed me Apple's kind of a matured company now.
Sure.
It's still innovating, don't get me wrong, but it's in its life cycle, it's more of a mature thing. And that's why you get your biggest dividends typically out of blue chips.
Sure.
Banks, financials, things like that. So, it's important to understand that. I do want to give even more historical perspective. If you look at how much of the return by decade comes from dividends, let me give you some perspective here. Do you know what I mean by that?
Because we already broke down that the return on a stock or the return on investment is broken down sort of out of three components, and one of those components is the dividend yield.
Yep.
And so historically, how big of a component of return has that piece been? That's the question you're going to answer.
And you've seen some change, and I think it ties into that macro analysis I just did, that we have a technology-driven market in a large part. Historically, from 1930 to into 2016, that's the data I was able to find from Hartford funds. Okay. 43% of your return as an investor has come from the dividends.
Okay.
So you're like, wow, man, that's
pretty significant, almost half.
That's 43%. So I want to get quickly, 60s it was 44%, 70s it was 73%, but listen, here's where the change comes in. It ties into what I just told you.
Sure.
The 1980s was 28%, 1990s was 16%, 2000s was less than 5%. The actual chart says NA for not applicable.
Wow.
And then in the tens, seems weird to go from the 90s to the tens, is 18%. And that's kind of where we are. If you think about the historical return of the market is around 10%.
Sure.
If the return is 18.5 is the 1.85% is the dividend yield.
Right.
You can see that's, getting close
about
to 18%.
Yeah.
So it's, I don't know that this trend is changing.
Sure.
Because buybacks are considered more tax efficient, but it is something you need to be aware of, because here's why I tell you need to be aware of dividend yields as well, because they do make a big impact on that return since it is close to 20%. And then I'll never forget, I had a mutual fund wholesaler come see me. This is 10 years ago or so. I mean, time gets away from me. But they showed me their fund, and they were bragging about the fact that they outperformed the S&P 500. Their fund did 10, and I think it might have even been 20 years.
Okay.
And I was like,
that doesn't make any sense.
How is that possible? So I went and looked at it and read the fine print, and here's what they were doing. They were stripping out the dividend of the S&P 500 in their calculation over that 10 and 20 year period. They were only looking at the change in prices. Right. From a day-to-day basis or a year-to-year basis.
We know there's three components to return, and dividend is historically 43% of that return. So that's and pretty
probably
significant.
More in modern times, like 20% of your return. So you can see if you take out dividends, you are hampering the performance by about 20%. So make sure that you're paying attention to dividends. And then here's the last key point that I want to make on this. Since you hear that at least 20% is coming from dividends, here's something you need to make sure you're doing with your investments if you are in the accumulation stage of your life. Meaning, when I say accumulation, you're trying to grow your assets for retirement or whatever purpose you have. Make sure you're reinvesting.
Yeah, that's a big one.
I mean, it doesn't do any good if you have that money pay out on your dividends, that 2% of of the return, and then it just goes to cash. If you're in the accumulation stage, I understand if somebody who's retired, you might want that yield. But somebody who's in the growth phase, let it be reinvested. Let it keep working for you.
Yeah, if you've listened to any of our previous shows where we talk about, financial habits of the ages or how to have millionaire tendencies, we always talk about one of the biggest assets that you have is compounding interest and time, and we love dollar cost averaging strategies as a means to build wealth and accumulate assets. Well, one of the easiest ways in the world to set up a dollar cost averaging strategy without even meaning to is having your dividends be reinvested, reinvested. And so we've talked about sort of the two components of that three-legged stool. And frankly, they're kind of two that you can't control a whole lot. You really can't control the earnings of a company unless you're involved in the management of that company. You really can't control the dividends that a company is paying out. So what can you control, or what things are sort of in your realm when it comes to being an investor?